Okay, here we are. Hello, everybody. It's 10 o'clock. It's Wednesday. I haven't said this since the middle of December. So we have had nearly a month away from each other. It's good to see you all. I hope you had a great holiday. I hope you got some rest and spent some time with family and all the things that are wonderful about the holiday season. I know I had an opportunity to take some time off, so I'm a happy guy right now. But good to see you. We're going to jump right into it because we have a lot to talk about today. Today's topic for the Financial Focus is going to be 2025 updates. There's quite a few. We're going to go over those. It's not exhaustive. There are, I'm sure, updates that we're not going to cover. If you have questions specifically about anything that concerns you, you can reach out to us at questions@attleborowealth.com. That's questions@attleborowealth.com. I hope you got to see some of the greatest hits videos that we sent out during the break. And, you know, one of them, we repackaged the one that we did about Social Security. There's one I did with this fella, and it kind of took me down this path of the not a guru and how you shouldn't be taking the information you receive on YouTube and any other service as advice, but just education. So I had this. I showed this video about this fellow who was recommending collecting Social Security at age 62. And if you haven't seen it, go to the YouTube channel. But it used to be in two parts, and I had been given some advice that it made sense to break up these videos in the past and to make them shorter, but it actually didn't work out to be a good thing. So because the first video was getting a lot of views and then the second one not so much. So we're packaging them back up, and then for this greatest hits series, we did that one as the first one, and it's titled is Collecting Social Security a Scam, or Waiting to Collect Social Security a Scam. Well, it has nearly 30,000 views since we launched that a few weeks ago, and it just goes to show you how many questions there are about Social Security. So if you haven't watched it, watch it, and let me know your thoughts on it. And good morning, everybody. Good to see you. I was just going to say, let me know you're out there. Okay, I'm just going through my notes here. So we have some upcoming events for everybody. Don't forget you've got estimated payments due today. So that's something I would just always like to remind you about. So January 15th, 2025 is the final fourth quarter estimated payment for your tax year 2024 if you make estimated payments. Upcoming events that we have classes, live classes, in-person classes beginning at the end of the month at Rider University in New Jersey. So it's been a little while since we've been live. Well, frankly, it's been since before the pandemic since we've been live there in New Jersey, and specifically at Rider University. So classes start Thursday, January 30th. So like we always do, we have 2 Thursday classes. These are 2 3-hour classes, so 6 hours in total. And then that says January 30th and February 6th. That class is full, by the way. We've got a couple seats left, but I'm sure as I'm talking, that's probably full. And then we also have Tuesdays, February 4th and February 11th, and that class is about half full. So if you want to go, you can let us know, and you should receive an invitation. If you're hearing this, you're likely on our email list, and you'll receive an invitation. If you want an invitation to this class, it's a live class. Remember that. You have to be there live. It's not video. We're not going to have a video feed or anything like that. I'll do that throughout the year. I'll do one of these classes, at least one as a webinar. But if you want to attend live in New Jersey, you can reach out to us at questions@attleborowealth.com. That's questions@attleborowealth.com. And for those of you who are just listening on the podcast, and that's a growing audience, or just listening on YouTube, I'm showing that email address, questions@attleborowealth.com, on the screen. And I'm going to be sharing my screen later, so you might want to just watch the video. Okay, a couple of headlines that I want to review with you. So the first one is, as of today, we got the CPI data, so the Consumer Price Index. So I'm going to read you the report from Yahoo Finance. It says, new data from the Bureau of Labor Statistics out Wednesday, today, just about an hour ago, showed that a key inflation metric eased for the first time since July. So there was kind of a sigh of relief from the markets, and we're starting to see that already this morning. I'm just looking at my screen there. But on a core basis, which strips out more volatile costs of food and gas, the December Consumer Price Index climbed 0.2% over the prior month, a deceleration from November's 0.3% monthly gain. On an annual basis, prices rose 3.2%. So prior to December's report, core CPI had been stuck at a 3.3% annual gain for the past 4 months. It was the first time since July that year over year CPI saw a deceleration in price growth. So that's good news. And yesterday we had the PPI report. So these are wholesale prices. Wholesale prices rose less than expected in December. Also a positive sign for the economy that inflation isn't falling as quickly as hoped to the Federal Reserve's 2% target. Tuesday's report from the Bureau of Labor Statistics showed that its producer price index, which tracks the price changes companies see, rose 3.3% from the prior year, up from the 3% seen in November, but below the 3.5% increase economists had projected. So again, below the increase. So now I'm going to share the Slott report. So I share these so you can read along. And again, if you're just listening on the podcast, you can watch the video if you're not quite catching these important bits of information we share from the Slott group. But one thing I didn't mention is next week we have Andy Ives from the Slott group joining us. And we're ping-ponging back and forth about what we're going to talk about. I think we're going to talk about some trusts as IRA beneficiaries, but we'll see what the final answer is by the end of the week this week. But this report here, IRS issues mandatory Roth catch-up regulations. So this came out, again, just today by our friend Ienberger. And I will just read this along with you. One of the more controversial rules in the 2022 Secure 2.0 Act is the requirement that plan catch-up contributions by certain highly paid employees be made on a Roth basis. Last Friday, January 10th, the IRS issued proposed regulations on the new rule. So proposed regulations really stand as the regulations until the final regulations come out. So this is really what people should be following. Congress intended for the Roth catch-up mandate to be effective on January 1st, 2024. However, in response to a flood of complaints, the IRS in Notice 2023-62 delayed the effective date until January 1st, 2026. The delay means that until next year, plans can continue to accept pre-tax catch-up contributions from all employees, including highly paid employees. The proposed regulations are not technically effective until after the IRS issues final regulations, but plans are allowed to follow them in the interim, and really they should. Since the regulations are mostly taxpayer-friendly, most plans will want to do that. The regulations confirm several unanswered questions about the new mandatory Roth catch-up contribution, most of which were originally addressed in Notice 2023-62. The Roth mandate applies to 401k, 403b, and governmental 457b plans, not to simple IRA plans. The requirement only applies to employees with wages from the employer in the preceding year that exceeds a dollar threshold. The IRS confirmed that wages, that's quote-unquote wages, means wages subject to FICA. That is, amounts reported on Box 3, not Box 1 of the W-2. The dollar threshold would have been $145,000 in 2023, wages for 2024, and would have remained $145,000 in 2024 wages for 2025. But it will go up in future years based on inflation. The threshold on 2025 wages for determining required Roth catch-up contributions for 2026, when the rule becomes effective, will not be available until the end of this year. Self-employed individuals have self-employment income, not wages. If a self-employed person's income exceeds the dollar limit in the prior year, is she required to make catch-ups on a Roth basis? The IRS says no. Only highly paid workers with actual wages are subject to the Roth rule. The look-back wage rule means that new employees, no matter how well paid, will get a free pass in their first year of employment because they have no wages the previous year from the new company. And because the IRS says the dollar threshold is not prorated for the first year of employment, some highly paid employees also will not be affected in their second year of employment. One important issue the IRS punted on in 2023 was addressed in the new regulations. What if a plan doesn't already offer Roth contributions since they're optional? So this is a big one here. I know there's a lot of other technical information above it, but this is a big one for typical, your everyday 401k participant. So what if a plan doesn't already offer Roth contributions since they're optional? The IRS says it will not force an employer to put in a Roth option, but if the plan does not have a Roth option, pre-tax catch-ups could only be made available to lower paid employees. So those who would not be subject to the mandatory Roth rule. Higher paid employees could not make any catch-ups, pre-tax or Roth. Of course, most employers would be uncomfortable with this arrangement, because it would alienate its highest earning employees. So the practical impact is that plans without a Roth contribution option will likely have to introduce one in 2026. This is the only mandatory Roth rule in Secure 2.0. Many affected employees may be better off taking catch-up contributions on a Roth basis anyhow, but starting next year, they will have no choice. So that's a really interesting direction from the IRS. And I included this so you can imagine not having this webinar. Thank you, everybody. Hello, Thomas. Everybody who said hello, Jerry, Denise, Martin. Good to see you all. But you can imagine not having this webinar for 4 weeks now. There was a lot of information to go through for the Slott report in particular. But this is a great one, and one that you hear me talking about all the time. So let's go through these beneficiary form resolutions. It reads, we are 2 weeks into 2025. Have you been following through on your New Year's resolutions? As our readers already know, for an IRA owner not to follow through on his or her annual checkup of beneficiary forms could have dire consequences. Repeat after me. In 2025, I will obtain a copy of the beneficiary form for each IRA I own. Ensure I have named a primary beneficiary and a secondary or contingent beneficiary for each IRA I own. If there are multiple beneficiaries, make sure that each beneficiary's share is clearly identified with a fraction, a percentage, or the word equally if applicable. Ensure that the financial institution has my beneficiary selections on file and that their records agree with my choices. So we review this, of course, every year. You should maintain copies of your beneficiary designations, have them somewhere. If you keep your documents online or if you keep them in a folder, you should have that somewhere easily accessible to you, because we've seen it over and over again that these documents disappear. Keep a copy of all my IRA beneficiary forms and give copies to my financial advisor and attorney. Let my beneficiaries know where to locate my beneficiary forms. Review my beneficiary forms at least once per year to make sure they are correct and reflect any changes during the year to new tax laws or major life events such as death, birth, adoption, marriage, remarriage, or divorce. Check the IRA custodial document for every financial institution that holds my IRA funds. I will make sure that the financial institution allows the provisions that are important to me and my IRA beneficiaries. Each custodian has their rules about how they handle distributions from IRA funds where there are no beneficiary designations. So you've got to know what the rules are of the institution where your funds are, or just make sure your beneficiary designation forms are up to date. And that second one is the best option. Do all the above for any company retirement plans accounts I have, like 401ks, 403bs, or 457 plans. Don't leave it to chance, folks. Just too many things get lost on a regular basis, and we're always surprised at what we find throughout the year. So here's our Slott report mailbag, and I really love this, both of these questions. So this is from, again, Ian Berger. The first question is, I am planning for a required minimum distribution, or RMD, from both my IRA and 403b plan for 2026. My first RMD year. I am in the third year of a 10-year period in which I am rolling over 10% of my 403b funds each year to my IRA as a way to consolidate. This is per my 403b contract. So this is another example of why you have to know what's happening with your retirement plans. Because this person, like unfortunately many people, are subject to withdrawal limits in their retirement plan. In this case, they can only take a 10% withdrawal or distribution every year and roll it, even if they're rolling it into another IRA, or heaven forbid, want to do a Roth conversion. So you could have $2 million in your 403B contract or your retirement plan, and be limited to the amount of money that you can take out. In this case, it would be $200,000. So that may be enough to settle what you want to do if you're doing a Roth conversion, but or distributing funds to limit on or to live on, but it may not be enough. You might want to do more than that. So the funds get rolled over in September each year, this person writes. In 2026, do I need to take my RMD before the 10% rollover on the balance of my 403B? Are there regulations or just preference as to when I should take the RMD? So this is a really clear answer, and it's a really great question. I'm glad it was brought up, and I'm glad we're talking about it so early in the year. So Ian writes, hi, Claudia. Yes, starting in 2026, you will need to take your RMD from the 403B plan before doing the rollover to the IRA. That's because the first dollars paid out of the 403B in any RMD year are considered the RMD. And that's not just for 403B plans. That's for 401ks, it's IRAs, it's all of them that have to do with RMDs. And RMDs, so let me read that sentence over again because I interrupted it. That's because the first dollars paid out of the 403B in any RMD year are considered the RMD, and RMDs cannot be rolled over. There is no rule requiring you to take RMD at any particular time during the year as long as it is taken before your rollover in September. Next question. And that's before any Roth conversions too, folks. Make sure you take those RMDs before Roth conversions. Question. I believe that my RMD can be taken from any account to satisfy the total RMD, but does that apply to different types of accounts, such as an IRA and a 401k? A related question, can I use a qualified charitable distribution or a QCD from an IRA to satisfy the RMD for both my IRA and 401k? Thanks for any insights you can provide. So those of you who listen on a regular basis are probably saying, no, you can't take an RMD for an IRA from a 401k, and you know all the rules, or at least know the questions to ask. But let's allow for Ian to answer this question. So Ian says, John, you can satisfy the total RMDs of all your IRAs and any SEP or simple IRAs from any IRA or SEP or simple that you have. But RMDs from IRAs and retirement plans like 401ks must be taken separately. Meanwhile, QCD, qualified charitable distribution, can only be used to satisfy an IRA RMD. Great advice, as always, from the group at Slott. Okay, let's talk about the markets, huh? I have some annual or year updates that I'm going to share. I'm going to share the chart that I typically look at. I'm just moving my keyboard out of the way. But first, I want to share our analyst report, our analyst statement from last week. So this is regarding the week ending January 10th. So there was some reports that came in. The first was ISM Services. The survey of service providers rose 54.1 from 52.1, while the forward-looking new order component came in at 54.2, up from the previous reading of 53.7. The prices component rose a surprisingly large 6.2 points to 64.4. Activity in the service sector remains strong, but the price rise feeds into the recent data that shows inflation may not be receding, increasing uncertainty as to future Fed actions. We have the Fed minutes last week. So the notes from the last Fed meeting, in which the Fed cut rates by 25.25%, revealed that the majority, in quotes, majority of participants thought the cut was a close call, again in quotes. Additionally, some members, a lot of quotes, some air quote members, thought rates should stay unchanged, and the participants indicated that the committee was at or near the point at which it would be appropriate to slow the pace of policy easing. The minutes seem to indicate that the Fed either held rates steady or boosted rates, with minor sections mentioning why a cut was appropriate. Incoming data will determine the next moves, but these notes indicate the Fed is unlikely to cut rates in the foreseeable future. Very interesting. We had a labor report. The U.S. economy added 256,000 jobs in December, well ahead of the 155,000 job increase expected, while the unemployment rate ticked down 4.1%. Average hourly earnings increased 0.3% month over month and 3.9% year over year, the latter of which was slightly lower than expected. And our analysts say that a hot job report is positive for economic growth, but increased concern among investors that inflation may see a resurgence as the odds of rate cut in the first half of the year dropped sharply following the release. So we talked about PPI that we had yesterday. We talked about CPI that we received today. Tomorrow, Thursday, we have retail sales. And in their market recap, they talked about I'll just read it to you. So strong economic data and some hawkish Fed comments conspired to push stocks lower and yields higher. So we're talking about bond yields. And this is again, the surprising part of the market to me. And why you've heard me say so many times that the most difficult part of the market to manage are bonds. Because, we're seeing these Fed rate cuts and you think interest rates are going down and the Fed rates are going down. But, we'll look at what the 10-year Treasury is, and we look at the data, but that's approaching probably 5%, again, or high fours. So the Fed can do whatever they want, and the market is going to react however it does. Let's see where it was. Push stocks higher. So strong economic data and some hawkish Fed comments conspired to push stocks lower and yields higher in the shortened trading week. Inflation concerns have been rising in recent months, and rates may stay higher for longer. But a strong economy appears to be able to handle higher interest rates, and we believe recent weakness is likely short-lived and the bull market remains intact. So let me share with you, that's the end of the analyst report. So let me just share my screen with you here. I'm just checking time. I'm going to share this is a report I get from Invesco, so this is not a recommendation to buy, sell, or hold any Invesco investments. This is just information that I receive and I like to share. And typically, I just talk about these numbers, but as this is December, the year end, December 2024, I just thought I'd share some things with you. And while I have the screen up, I'll just go ahead and share the rest of it, the week report. But you can see the Dow Jones Industrial Average. I'm over here, and we're going to talk about, equity equals stock. That means stock, right? So these are the stock markets, U.S. and around the world. So the Dow Jones Industrial Average ended up just about 15% for the year. 5-year average is 10.54. 10-year average is 11.55. These are really, really strong numbers. The S&P 500 was up 25%. 14.5 for 5 years and 13.07 for a 10-year number. The NASDAQ is up nearly 30%, 29.6% in 2024. 5-year average is 17.52. 10-year average is 16.25. And then you get into the more global. So these are all U.S. markets, right? Global companies, but U.S. markets. So here we have more global markets. So the MSCI World Index, not including the U.S., was up 5.33%, just about the average for 5 and 10 year. Emerging markets, so smaller economies, just 8%, just about 7.97 for the year. A 5-year average is 2.05 and 4.01. The Europe, Asia, and the Far East is 4.43, 5.33 for a 5-year average, and 5.80 for a 10-year. So this is the all-world stock index, the MSCI all-world stock index, 18.03, 10.59, and 9.80 for the averages. I hope you can see that okay. Let me make this a little larger. And then smaller size companies around the globe, not including the U.S., 7.66, 6.667 for a 5-year average, and 10-year average is 7.26. These are all really strong numbers. Now let's come down to fixed income, and fixed income means bonds. So you'll see here that this average actually closed up. This is the aggregate bond index. So this is a maturity of about 7 to 9 years. So that's when the bonds mature. You'll hear me say that this is where most investors have most of their money. That's just where they tend to fall in their in their grand scheme of asset allocation. That was up just 1.25%, and that was a stinking roller coaster throughout the year. So there are a lot of times throughout the year that this was a negative number. We just happened to end positive. The 5-year average is negative 0.33%. And then 10-year average is 1.35. So pretty darn low for a 10-year bond average. Now look at the 1 to 3 year number. That was for the year is 4.39. That's this inverted yield curve we're always talking about, where higher interest rates over here on the left-hand side, where, these are shorter maturities and then longer maturities. So if we had 3 months, let's just say, because there's no zero maturity, and then 30 years, typically you get higher interest rates as you go out in time. But this yield curve, you can see, is still working the other way. So we have higher interest rates here, and then we have high yields. So these are junk bonds. I'm sorry, I didn't finish this out. But even though this was a good year this year, 4.39, we still have low numbers, 1.53 over 5 years and 1.61 over 10 years. Now, junk bonds or high yield bonds, more credit risk, 8.19% for the year, 4.21 over 5 years, 5.16 over 10 years. So I'm not going to go through each one of these, but you'll see that that bonds, are shaky and don't always give you the best return in this market the way we're doing it now. I'm not saying you shouldn't have bonds in your portfolio. I'm just saying that you've been hearing me say for a long time that this is one of the most difficult parts of the market to manage. Okay, so now join me over here at interest rates. This is the last thing we'll review, but I just want to share with you the Fed funds target rate. You'll see last year this time it was at 5.5%. Well, we've cut 1% in total, closing the year at 4.50. 5 years ago, that Fed funds rate was 0.75. 10 years ago, it was 0.25. And then if we come down here, we'll see 6-month treasuries, and then you'll see the 10-year treasury. So I said earlier the 10-year treasury was closing close to 5%. It's gone up since this report here. But the 6-month treasury is at 4.27. The 10-year treasury is at 4.57. So that's more of a flat yield curve than an inverted yield curve. We don't have the 30 on here. No. All right. So that was all of 2024. So a lot of great information on this slide here. Now let's look at last week. Yep. So look at this. Here's what I was just talking about, the 10-year treasury. And this is, Fed's cut rates, but we ended the year at 4.57%. Look where we ended the week last week, 4.76. Why is this important? Because as interest rates go up, bond values fall. So there's a direct correlation here if we follow this, right, over to here. Now you'll see that so far in this year, as of Friday, bonds have lost money, 0.87%. So, a lot of people view this as a stable part of their portfolio, but my goodness, you're down already just about 1% for this year, for that week, and certainly 1% year to date. Year over year, it's 1.18%. But the markets are all down too, the stock markets. So again, these are stock markets. These are bond markets. And if you're just listening on the podcast, I'm sharing my screen that has a chart that reflects all this information. So you might want to watch it on YouTube. But you'll see here we're in that situation just like we were in 2022, and I'm not saying that this is how the year is going to end, but year to date, the Dow Jones Industrial Average is down 1%, and your bond portfolio is also down 1%. So that's where people start having problems when they have the typical type of investment management that most people have, like a 60-40 portfolio or 70-30 portfolio that's very static and doesn't have any dynamic investments in them to help protect those kind of downside draws, or a planning strategy that we use like the account segmentation. But you'll see, you just take a snapshot, all these stock markets from the major U.S. markets here to the world markets, all down over the past week, all down so far year to date. And nobody should be surprised by that. You can't have these. Well, I guess you can. It's highly unlikely that you have big numbers like we saw last year and then hit it out of the park, certainly right again in the beginning of the year, because you get a lot of people taking profits and things like that. And you also have a lot of uncertainty going into this new administration, and any new administration, even though this administration's been here before, it's new. And there's a lot of uncertainty about what's going to happen, and that affects the stock market. The stock market does not like uncertainty. Neither does the bond market. All right, let me just check to see if there's any questions before I move on. to the updates for 2025. So this is the financial focus part of the webinar. And if you're just joining us, we're coming on the tail end of the of our weekly webinar. You may want to go back and look at that. But this year, or today, we're talking about important 2025 updates. So I'm going to share my screen here, and I'm going to share some material and some excerpts from reports and information that I receive. I'm going to share it with you. So here we go. So the first thing I want to go over with you is from our wonderful Heather Schreiber. So Heather Schreiber, you guys know, is she's our Social Security expert here on the team, and Heather is one of the top in the country, and we're really, really fortunate to have her work with us. So here's some updates from Social Security that I wanted to include. So the first one is the SSA, Social Security Administration, that is, has announced that as of January 6, 2025, SSA customers are required to schedule an appointment for service, including requests for Social Security cards. The SSA has presented updates to its overpayment waiver process in order to ensure fairer outcomes and reduce administrative hurdles. Ending the coverage gap, all Medicare plans must include a $2,000 cap on out-of-pocket expenses for covered prescription drugs starting in 2025. The standard monthly premium, we're going to look at the Medicare planning chart here. The standard monthly premium for Part B, which covers medical services, increased from $174.70 in 2024 to $185 in 2025. That's a 5.9% increase. That's a 5.9% increase in your Part B Medicare costs. Not to be outpaced there, or definitely to be outpaced there. The Social Security COLA from 2024 to 2025 was only 2.5%, continuing the trend of healthcare costs outpacing overall inflation. So, you know, we factor in a 5% increase in our financial plans for healthcare costs. Maybe we should increase that to 6%, but we'll see what the trend is here. This is from another Slott report. I didn't include this in the previous webinar, but I just took an excerpt out of here. A big change to the required minimum distribution rules made by the 2019 Secure Act requires most, so this is a change in 2025. This requires most non-spouse retirement account beneficiaries to empty the inherited account by the end of the 10th year following the year of death. IRS regulations also mandate that any beneficiary subject to the 10-year rule who inherited from someone who has started RMDs must continue in them during years 1 through 9 of the 10-year period. However, because of confusion over this rule and IRS misinformation, the IRS did not require annual RMDs for beneficiaries in this category for years 2021 through 2024. Starting this year, yearly RMDs become due. We're talking about inherited IRAs. There was never a delay or a forgiveness of penalties for your own RMDs, not from this. But this is for inherited IRAs. But this year, that's over. 2025, you got to start taking those RMDs. And it references the Slott report. So another update from Heather, and this was separate than from what I shared with you before. And a lot of you have heard about this already, but on January 5th, 2025, President Biden signed the Bipartisan Social Security Fairness Act into law. The SSFA repealed 2 provisions that were often criticized for reducing Social Security benefits for individuals who receive public pensions based on earnings not covered by Social Security. These changes will retroactively take effect for benefits received after 2023. The SSA is currently working on how to implement the repayment process for those affected. Let's see how long that takes. So the government pension offset, this was a change also as part of this rule. The government pension offset enacted by Congress in 1977 historically reduced or eliminated Social Security spousal and survivor benefits who received non-covered benefits. The repeal of the GPO, that's the government pension offset, the repeal of the GPO will remove the barrier and restore benefits to roughly 750,000 recipients, according to the published data as of December 23. And then we had the windfall elimination provision, or the WEP, enacted in 1983, reduced but never eliminated a worker's Social Security, retirement, or disability benefit who lacked 30 years of substantial years, who lacked 30 years of substantial years of Social Security earnings, and who also received a pension based on non-covered work. The the WEP impacts roughly 2 million income beneficiaries. So that was eliminated as well. So good information from Heather and the Slott group that I wanted to share with you. Now let's go into our tax table updates. I know you all have been waiting for this, and this information has been out there for a little while, but and it will soon be available on our website for download. I get a lot of downloads every day from our website. Our website is newly redone. We're continuing to make some adjustments and changes. So if you see anything that doesn't look right, a period is off or something, I just had to make changes to the webinar page because there was some incorrect information there. Nothing bad. It was just still referencing Tuesday weekly webinars, and we don't do those anymore. But if you see something that call it out to us, and we'll get it fixed. But these charts that I'm going to share with you are available for 2024 still on our website, and our website is attleborowealth.com. That's attleborowealth.com. And I'll just share with you real quick. No, I'm not, because I'd have to pull my keyboard out again, and I don't want to slow us down. But to go to attleborowealth.com, over in the top, you'll find this slot corner. You click into the slot corner, and then you'll scroll down to the bottom, and you'll see a section with all the charts that you can download. But let's start with the tax planning. So just like every year, we see an increase in the marginal tax rates. So let's start over here on the left-hand side. So for married filing jointly now, all these brackets have increased. So the ones that we're usually working with, especially when we're doing Roth conversions, are for single filers and married filers tend to be right in here, the 22 and 24. So the increases are, pretty substantial. The top of the 22 goes up to 206,700, and the top of the 24 now is at 394,600. And again, if you want to see the 2023 numbers, you can just go onto the website and download those. Then the top of the 24 for single filers is 197,000. The top of the 22 is $103,350. Now, I want to point out the big differences here between single filers and married filers, because one of the aha moments I often see in people's eyes when we're sitting across from the conference table or in class is I remind people that if you're a married couple going into retirement, one of you is very, very, very likely, and it's highly unlikely, that you both die at the same time, but one of you is going to pass before the other. When that happens, this option for you goes away. Well, that stinks. So you suddenly file as a single filer, and you can see the big difference. So your marginal tax rates may be the same, but the income that pushes you higher into those marginal tax brackets is much, much lower. So when we have a single person who's doing Roth conversions, it's more of a challenge. We get it done, but it's more of a challenge than a married couple. So the and everything's all the thresholds have increased. So we have capital gains over here. So the capital gains thresholds, you can pay zero capital gains if you're a married filing jointly couple with under $96,700 of modified adjusted gross income. Then you don't pay any tax. If you're a single filer under $48,350 of modified adjusted gross income, again, you don't pay any tax on capital gains. If you cross over these thresholds and you hit the 15% and the 20% marginal capital gains tax rates, these little asterisks apply to the ACA Medicare surtax. So that adds another 3.8% on top of these numbers if you have more than $200,000 in modified adjusted gross income for a single filer, $250,000 in modified adjusted gross income for a married couple. I don't think that's increased, but I'll check that. And then transfer taxes has increased, so now the exemption is nearly $14 million per person. What does that mean? That means that an individual can have $13,990,000 transferred before there's any federal estate tax. If you go over that, the maximum rate is 40%. And the annual gift tax exclusion, so that's the gift tax exclusion is the amount of money that you can give to any person and it can be multiple people if you'd like, is now $19,000. Anything over that, you should file a gift tax return. And what happens is, when you file that gift tax return, that reduces this exemption amount. And then the standard deductions increase. So it's now for a married joint couple, it's $30,000. For a single couple, single person, single filer, it's $15,000. Head of household is $22,500. And you get a little bit more if you're over 65 or blind. And if you're over 65 and blind, you get even a little bit more. Let's see. And that's it for that chart. Trust tax rates, also the income on the marginal rates have increased. Now let's talk about the IRMA, so Medicare income planning. Just checking my time. So this is if you're working through tax efficient planning and you're not focusing on IRMA, you should be, because you can go into, this is taxable income, right? So you could be at the top of the 24. We just had this conversation with somebody yesterday, a client yesterday, and we could go to the top of the 24% bracket at $394,000 of taxable income. But that would likely, I say likely because these are 2025 numbers, where the IRMA won't be assessed for what you do this year until 2027, and there'll be inflation built in. But if we use these numbers here, that will take you over this threshold, right? So go back. What I was talking about was converting up to $394,600 in taxable income. So now taxable income and modified adjusted gross income are two different things. IRMA is driven by modified adjusted gross income, right? But your modified adjusted gross income will certainly be over $334,000 in this case, and so that'll bump you up into this next bracket. So what does that mean? So now for Part B, you pay $295.90 more than you would. So it's $185 plus the $295 for your Medicare benefits. So that's your total, $480.90 per person. So if you're a married couple, then you cross this threshold, then you're both paying, let's just call it $500 a month more for your Medicare benefits. Now that may make sense for you. Believe it or not, sometimes it makes sense to push into those higher IRMA tables. But you got to do the math on that. So we have a calculator that we made. We call it the Wheeler calculator because Emily Wheeler created it, one of our team members. And you've got to do that calculation to see if it makes sense to pay a higher amount for a shorter period of time as opposed to potentially paying a larger amount or a smaller amount over a long period of time. But if you're doing wealth conversions, you have to pay attention to IRMA. And it's not just Part B. It's also Part D. It's got its own surcharge. So using this bracket again, this one here, if you go into that, you add another $57. So now your total surcharges for Part B and D is $352.90 again, plus the $185. So be aware of that. You can go really high into $530 a month per person plus the $185. So you want to pay attention to that. Again, it's a 2-year look back. So these, we can inflate these numbers to see what it potentially will be like in 2027 when these surcharges or phantom tax or penalties, however you want to call it, get applied. But this is what we're working with today. All right, now let's talk about contribution levels. So retirement plan contribution limits. So I really, really appreciate this chart because it not only gives us 2025 numbers, but it gives us prior years. And that's really helpful, at least to my brain. Let's first talk about phase-out ranges for IRA deductibility. It doesn't affect a lot of people we work with, but now a married couple, if they make more than $146,000 in modified adjusted gross income, then you can't deduct contributions from your IRA. You can still make that contribution to your traditional IRA, but you can't deduct it. This lower number starts what's called a phase out. So the 126, if you go over that 126,000, then you can deduct less and less. But it doesn't mean you can't contribute to an IRA. You can still contribute to an IRA if you otherwise can, but you can't deduct it. Now, a big one here is 401ks and 403b plans. So the amount that you can contribute has increased slightly. I really wish they would goose this up a little bit more, but in 2025, if you're under 50 years old, you can contribute up to $23,500. Let me make this a little larger. And then if you're over 50, you can put another $7,500 in, and that increases it to $31,000. So that's something to check right now. So if it's $500 more for the year, you want to check your plan to make sure that you're maximizing your contribution if that's what works best for you. You don't want to wait until halfway through the year and you say, oh, geez, I missed that. I've got a very, very good accountant who happens to also now be our CFO. And right in the beginning of the year, he wrote me an email and he said, oh, I made the increases for you and your wife for this year's contribution levels. And I love that. He took care of that for me. But you gotta check those and make sure if you want to maximize that you are. Here are the Roth and IRA contribution limits. So if you're able to, again, you can always contribute to an IRA, but you may not be able to deduct it. But there are, we're going to talk about the Roth phase outs, but there are maximum amounts that you can contribute to IRAs. Now, Roth 401ks fall under this, right? So it doesn't say traditional 401k or traditional 403b. This is traditional or Roth. So many people think, and I've had surprisingly, some professionals who say, well, geez, you can only put $8,000 into the Roth 401k. Well, no, you can put, if you're over 50, this year, you can put $31,000 into your Roth 401k if you want to. But an IRA, so 401ks, 403bs, retirement plans are different. They act the same way, so it sometimes seems like they follow the same rules, but they don't follow the same rules. So if you're under 50, so less than 50, you can contribute $7,000. If you're over 50, you can add another $1,000. That's your $8,000 contribution. Now with Roth IRAs, there are some phase-out levels. So now, this is a little different than the deductibility. If, as a married couple, you're in this area here, $236,000, $246,000 in modified adjusted gross income, then you either can't contribute if you go over here, or you can contribute less and less throughout this phase-out zone. And you cannot contribute to that Roth IRA. Yes, you may be able to do what's called a backdoor Roth contribution, where you contribute to the IRA and then immediately convert it to a Roth IRA. There's a lot of speed bumps and concerns and potholes, whatever you want to call it, that you should be aware of with that strategy, and you certainly want to work with somebody who understands it if that's what you're going to do. So that's for a married filing joint couple. Single or head of household, this phase out is much, much lower. It really stinks if you're filing as a single filer. So you want to do your planning if you're married while you're still married. So that phase out is at $150,000 to $165,000. So again, if you're at $150,000, then you can, it starts to reduce. If you're above $150,000, that contribution level, contribution amount starts to reduce. If you're over $165,000, you can't put anything into a Roth IRA. Let's see what else is on here. You have simple IRAs down here. They carried it down to page 2 because the rules are, this all used to be on one page. Now it's expanding to 2 because the rules get more complex every year. But that is it for. Oh, I'm sorry. Here's SEPs. So I don't see a lot of SEP IRAs, but you can see the contribution level. So 2025 takes it up to $70,000. Now SEPs can now be Roth. As of last year, SEPs can now be Roth, and simples can also be Roth. So that might work for you. So Roth is after tax. You should know that. And if you don't, now you do. Something that's often overlooked are HSAs, health savings accounts, and if they are used, sometimes they're not taking full advantage of. So what is a health savings account? So if you have a high deductible plan, you're able to contribute an amount of money for future use, or honestly for immediate use if you wanted to, for qualified medical expenses. So in 2025, if it's just for you, there's a minimum deductible. So the maximum where's my limits? That's what I'm looking for. Okay. So we have, if you're under 55 and it's just you, $4,300 is what you can put in. If you're over 55, we're at 53. If you're a family, it's $8,550. If you're a family and over 55, and that's me now, $9,550. So that's what can be with a high deductible health plan. Now the HSA, you could put that $9,550 in if you're over 55 and have a family and a high deductible plan, and then use it throughout the year, or you could stockpile it for future use. So that's item number one, where most people, a lot of people, don't properly use their HSA, in my opinion. First of all, it should be a future savings, I think, as long as you can afford it for retirement, because medical expenses, we talked about it in the beginning, the inflated number this year is 5.9%. That's 5%, 5.9%. That's tough to keep up with. So you should be, if you can, you should be socking this money away for future use. And then the second stumble I see people make with their HSA plans is they keep it in like savings accounts. Well, you typically have the ability to invest these funds. So if you have the ability to invest those funds in your HSA, take advantage of it. Do an appropriate investment allocation for you. If you need help with that, you can reach out to us at questions@outerboroughwealth.com. That's questions@outerboroughwealth.com, and we'll see if we can help you. If you can't invest it, then you might be able to go to a different plan. Your company may offer a certain plan, but you may be able to do something else. So you should take a look at that. And I think this is last here. Let me see. Yeah. So we've got some effective dates on from Secure 2.0. So this was a big piece of legislation, and there was some follow-up to it, but there was a lot that became effective in 2023 and 2024. So 2023, the RMD age was raised to 73. There's just a lot. I'm not going to go through over all that, but last year, the IRA catch-up contributions were indexed for inflation. QCD, qualified charitable distributions, they were indexed for inflation. They were at 100,000. Now they're at 105,000. Actually, let's see if that increased this year. Let's see what it is this year. This is my, 108,000, yes. And this is why I have this chart. This orange chart is one that stays on my desktop, on my conference room table. I have this all over because these numbers change all the time. And I famously say, just when I kind of get it drilled into my head what it is, it's time to renew it. And it starts all over again. So 108,000 now for QCDs. Was 100 last year. Was 2024 is 105. Now it's 108. But QCDs just became an index for inflation in 2024. Matching plan contributions can be made on student loan payments. 10% penalty exemptions, emergency expenses for plans and IRAs, $1,000 a year. 10% penalty exemption employers can offer in-plan emergency savings accounts, $2,500 maximum deferral for retirement plans only. 10% penalty exemption domestic abuse for plans and IRAs limited to $10,300 for 2025. Higher simple plan limits for deferrals and catch-ups. This is all last year. 529 to Roth rollovers. This was a big topic last year and still is today. There's a $35,000 lifetime limit, and there's other requirements for that 529 to Roth IRA rollover. No lifetime RMD on retirement plan Roth accounts. It used to be that 401ks, 403bs had Roth 401k and 403bs had RMDs, where Roth IRAs did not, but that's been changed. Surviving spouse may elect to be treated as deceased spouse, so that's a whole election that has to be done. Plan catch-ups must be Roth if wages are greater than $145,000. That's indexed, and that's delayed, as I reported in the weekly webinar section, until 2026. So what's effective this year? The expansion of the employee plans compliance resolution system, self-correction. Effective in 2025, higher catch-up limits for ages 60-63, and for plans, that's retirement plans, 401ks, 403bs, and simple IRAs. And then we'll talk about 2026 when 2026 rolls along. All right, so that's a lot. We covered our charts. We covered a lot of material. I think we covered it all. I hope these updates were helpful to you. I expect that the new new charts will be up. Again, it's a new website provider, so everything's working pretty well right now, very well right now actually. But we want to keep the 2024 charts up so you can use them until April and upload the 2025 charts. So I hope that's done by the end of the week, but perhaps by the end of next week, you should be able to download those charts. If you have any questions, as always, reach out to us at questions@attleborowealth.com. That's questions@attleborowealth.com. If you want to visit our website, you can go to attleborowealth.com. It's a newly revised website. As I said, if you have any input, please send it over to me. I'm happy to hear it, or completely disregard it, whichever one. I'm just kidding. I'm happy to hear it. I'm really happy to be back in front of you guys. I enjoyed my time off, but I'm happy to be back, and I missed you all. I hope you have a great week, and I'm looking forward to seeing you next week with Andy. Take care. Bye-bye.